Welcome back to part two of this mortgage series. If you liked what you saw last time, we can't wait to bring you so much more information. We got a ton of information to cover on this video. But before we get started, I want to give a huge shout out to Le Studio Canes, a wonderful podcast recording studio in the South Shore of Montreal. If you're looking to record a podcast like we are today, or to do any short form content, this is the place to be. Robin is absolutely amazing. I've been working with her for the last 2 years almost, and I'm so excited that she's got this beautiful space now. You can check out on their website at lestudiocanes.ca. Without further ado, let's jump right back in. In case you missed part one, I'm joined today by Mathieu Alexandre Poupart of the Orbis Mortgage Group, a super talented mortgage broker that I've had the pleasure of working with for several years at this point. I think it's time we continue this discussion.
Thanks for having me.
Now, we mentioned at the beginning of the show that we also want to talk about cashback options. And that's always been a hot topic because you hear people say, well, this bank's giving me $4,500 and this bank's only giving me $1,000. And this bank wants invoices for, inspections and notaries, all that kind of stuff. Tell us a little bit about how a cashback product works. What are the risks that come along with it? Are there any penalties that could come along with it? Please break that down for us.
Yeah, so I think there's three things I want to talk about. The first is that there are regular cashback offers where instead of a bank offering to pay your notary, they're going to offer you maybe $2,000 or $2,500 as cashback to cover the notary costs. There's always a catch though, always a catch. And in this case, for a regular cashback offer, it's normally that the mortgage payments come from an account from that same bank, right? So they're trying to incentivize you to open an account with them if you don't already have one. Because the truth is you don't need to have your mortgage payment come from the same bank that's offering the mortgage. But there is a catch, right? So with that, I find it's a very reasonable offer. I don't really see anything wrong with it. So all terms and conditions being equal, if the rate is the same and terms and conditions are the same from a bank offering the same rate but no cashback, I think that's a fair bet. You're not going to be trapped. There usually isn't a clawback, and a clawback is if you break the mortgage after 2 years and you had taken a 5-year term, they'll ask for that cashback for you to pay it back, right? To reimburse it. But generally speaking, for most banks, that's not the case with the standard cashback to cover notary fees if you open a bank account with them. Now, the second is where you can choose a lender and have them offer you a cashback based on the mortgage amount. So they'll say, we're willing to offer you 1, 2, 3, 4, or 5% cashback, which is
significant money,
very significant amount of money, but we're going to trade that off for a higher rate. So you can ask for like 2, 3, 4% cashback, and maybe you'll be getting, $8 or $9 or $10,000 cashback, which is great to help cover your closing costs. But that higher rate, like I said earlier, banks are very smart when they do these calculations. They know exactly what they're doing. That higher rate makes it that over the life of the term or the duration of the term, you end up paying more in interest. So is it always bad? Not necessarily, but you need to understand that, by going this route, you will end up paying more over a 3, 4, 5-year period. If you'd like the cash up front and it makes sense for you and you're okay paying more interest over a 5-year period, the difference isn't always massive. It is in the thousands. But it's not, tens of thousands normally.
And again, I think this circles back to the idea of educating our clients, making sure they understand what they're getting themselves into, making sure they understand the options available to them. Because ultimately, you and I do this every single day. But most consumers end up doing this once every 5 years.
Right.
On average, that's what they're looking at. If they are homeowners, if not, they never do this in their lifetime. So things change regularly. There are tons of fine print in every single contract. They really have to take the time to understand what's in there and know what the best option is going to be for them.
Yeah. And I think, the third I was going to mention, I kind of mentioned it in the first, but it's the clawback clause. So you have to be so careful when it comes to the clawback for cashback offers, because the truth is many Canadians end up breaking their mortgage early, whether it's because they're porting. You need to understand, will that $4,000 or $3,000 cashback offer be clawed back if I decide to refinance and change lenders or whatever the situation may be? So not all cashback offers are created equal.
What you said there, I've heard that up to 70% of Canadians don't make it to their term on
Right.
a 5-year.
Right. So the most popular term is a 5-year term.
Yeah.
But the truth is the average length of a mortgage in Canada is about 3 years, 8 months. So it's, most people, like you said, don't make it to the end of the term.
Think about that. 7 out of 10 people don't make it to the end of the term. So that's why the prepayment penalty is such an important part of your mortgage. And people don't take the time to look at that because they focus on that rate and they feel so good about saving the 10 basis points on the rate compared to the other institution, but don't realize that the interest rate differential, or however it's calculated in that specific scenario, it's going to be significantly larger. And like Matthew said, if you do end up paying one penalty of, most recently the one I saw was $18,000, you're going to make sure to never put yourself in that position again, because that is a ton of money, especially when you're trying to do the profit analysis of your investment.
Right. And it's also something that the bank has control over. We don't need to get into the formula because it's actually very complex and every bank has a slightly different way of calculating the interest rate differential. But I was just going to say that it is based with at least all the big banks on a posted rate. and they choose when to change the posted rate. They could, your penalty could be 18 grand today, and then they change their posted rate tomorrow. When you get to the notary, now it's 35K. Like it's just crazy. So it's just really important to be aware of it.
Okay. I'd say one more question that I've been getting a lot is has to do with HELOCs. It's like LJ, I'm thinking about a HELOC. I've heard never do this, do that. Can you just like quickly break down for our listeners what a HELOC is and how they work?
Yeah, it essentially is a line of credit that has your property as collateral. So because there is a collateral, they're going to offer you a more advantageous rate than what it would have been with a regular line of credit, which can typically be prime plus 3% around there. With a home equity line of credit, the typical rate is prime plus 0.5%. So that prime rate is variable. So you have to understand that rate can change. It can go down, but it can also go up. And the minimum payment monthly is interest only. So if you don't touch your HELOC and you don't borrow from it, it's not going to cost you anything. But as soon as you take 10K, 50K, whatever it is to do, let's say renovations or to buy another property, you'll start getting charged interest, and you'll have to pay a minimum monthly payment of the interest only portion. What's great is that you can pay more than that, and you can pay as much as you want. So if you wanted to clear that 10 or 50K 2 months later, there's no penalty to do so. So it's a really useful tool to have access to cash and to be able to pay it all down without paying any penalties. And so it acts like a more advantageous line of credit. Not all lenders offer it. The interest rates might vary because you're asking for a product with a HELOC. It doesn't mean it'll be a worse rate, but sometimes it can be. But it's a really useful tool to have. And most of the lenders that do offer a HELOC offer it on a owner-occupied property, but quite a few of them won't offer a HELOC on a rental property.
I think that's changed over the last 5 years. I think a lot of banks used to offer it, and now they're like, oh, we really want to hedge our risk. We see where their economy is heading, and we want to be a lot more careful with that.
Yeah, and it's not just with HELOCs. Banks tighten up their risk criteria every year on all the underwriting.
Yeah, it's crazy. I think a topic that everyone is super interested in is what are ways that we can save? We talk about how there's taxes, we talk about how there's tons of expenses, we talk about how there's just a lot of outflow of money, but are there any strategies for people to save when talking about mortgages and financing?
There's a few, and that's a really, really good point and question, just because it doesn't have to cost very much monthly. You won't necessarily feel the difference in your budget, but you're potentially going to save tens of thousands, maybe even more.
Hundreds,
honestly, over the span of a mortgage for sure. And so the first, and I think this is the most important, especially, and this I'd say is more specific to owner-occupied properties, right? So people who own their homes, but the accelerated bi-weekly payments, right? So instead of paying your mortgage on the 15th of every month, the 15th and the 30th, so bi-monthly, you do accelerated bi-weekly. So it's essentially 26 payments instead of 24. And what that equates to is essentially one extra month's worth of payments going directly to the principal. And over the life of a 25 or 30-year mortgage, you're shaving years off the mortgage, which equates to tens, potentially hundreds of thousands in interest savings. So that doesn't cost very much more on that, bi-weekly payment. You'll barely notice the difference, but you're going to save so much money.
Especially if you are on a salary and you get paid every 2 weeks. It is so easy to just know that every 2 weeks this is coming out and you don't even think about it. And for context, on a 30-year amortization, you're wiping off about 7 years of it. And on a 25-year amortization, you're wiping off 4 to 5 years of it. So it is not something to laugh at. It is a very significant amount of time that you are saving on the amortization of your mortgage. So if you are in that kind of position, I definitely recommend you do the accelerated biweekly payments.
Yeah, and another trick is to round up your monthly payment. So let's say you have a monthly payment of, $2,150. Round it up to $2,200. Pretty much every bank and every lender allows you to up to double your monthly payment if you wanted to. So if you have the budget for it, you can even increase it more than that. But just rounding up that extra $50, $60 will end up saving you thousands of dollars. It's a great tool. You won't notice it in your bank account, and you're going to save thousands.
So would you say there's any other tricks up your sleeve?
Yeah, there's one, and it's the prepayment penalty, right? Or sorry, the annual prepayment privilege. So you can make more than one prepayment a year on top of the regular monthly payment. So if you have $2,000, $4,000, or $5,000 or more, you can prepay directly to the principal, and that'll greatly, lower the amount of mortgage you have left to pay, drastically reducing the interest you end up paying every year. Now, what's important is that some banks allow you to do that prepayment once a year. And that's great, but it's not as good as it can be with other banks that allow you to do it every single month. Because if you do it at the beginning of the year, you'll end up saving on that interest immediately.
Right.
Rather than waiting to do it, at the half-year mark or the three-quarter-year mark, where for that first 3 quarters of the year, you're paying interest on that bigger balance. And then finally, once you make the prepayment, then you start your savings. So if you could do it earlier on and you could do it every month because you have an extra 500 or 1,000 or 1,500 every month to put towards your mortgage, might as well do it as soon as possible.
I'd say it's a great strategy if for whatever reason you receive a bonus income from your employer and you all of a sudden come into a large sum of money every single year, even if it's $1,000, $2,000, if you make that payment and just make it a regular habit of it, then you're just going to save thousands of dollars down the road, especially if it's for your principal residence. You get those savings in interest rate. You're going to have the capital gains exemption from your principal residence when you eventually sell the property. So you're just stacking on the benefits one on top of the other.
Yeah, and to circle back to the HELOC discussion we had, by doing that, you're also potentially increasing the funds available on your HELOC. So, I mean, you're saving, you still have access to the funds, you're win-win.
That's win-win, 100%. I know that a couple people have been reaching out and say, well, LJ, what does all this financing process look like? Like, LJ, I'm with you. We see some properties. We decide on the property. We get an accepted offer. I know that you send the file then to my mortgage broker. Matthew, what do you do when you receive the file?
Yeah, so typically once we have an accepted offer, clients will have 14 days to get an approval from a bank, right? So we need a final approval, no conditions. And so the biggest kind of thing that we're focused on is removing the financing clause, obviously. And clients will have typically already been pre-approved. So we'll already have a file for them. We're already set up to submit an application. And then it's really about just confirming, okay, what lender are we going with based on your objectives? These are the 3 or 4 best options that I recommend. These are all the things you should be aware of. And then they'll choose a lender, we'll submit the application. And then within that 14 delay, we'll get a final approval. And then balls back in their court to make sure that they're waiving all the conditions that they had set out in their offer with you guys. And then after that, we're going to the notary, right?
100%. And then at the notary, a lot of people ask, well, what happens at the notary? Well, first of all, you want to make sure you have your down payment ready. I'd say at least 3 business days before we get to the notary. It's super important to note that if you are taking advantage of some of the products that we discussed before, like the registered savings account, whether that's the FHSA, the RRSP, the TFSA, that you give yourself, I'd say at least 7 to 10 business days to withdraw those funds. It's not like just transferring from one savings account to another checking account. This takes time. I've seen institutions take 5 to 7 business days to transfer it out of one into the other. So make sure you give yourselves that headway so you can not be stressed at the last minute, not be worrying, not be calling mom and dad to try and get a loan for a week in order to cover the panic, if you will, and you're organized on that front. It's important to note that you're also going to have 2 appointments with the notary. You're going to go the first time to sign the mortgage deed. So that's usually going to be 2 or 3 business days before you go sign the the act of sale when you actually become the homeowner. When you sign the mortgage deed, it's usually a pretty long document. You're going to sign with the notary. It highlights all of your responsibilities as a borrower, what rights the bank has against the property moving forward. And then that gets registered, published into the public register. And then finally, we go sign that deed of sale. After that, when's the first payment?
The first payment can be up to 30 days after you become the owner. So depending on the payment frequency you choose, if it's weekly, biweekly, accelerated biweekly, or monthly, you'll be able to choose with the notary what date you want that first payment to be. But it has to be within at least the 30-day mark, cannot be past that.
Okay. And then sometimes people have asked me like, hey, LJ, I changed jobs. Now my payment schedule is different. Is it possible for me to change the date that I pay my mortgage?
That's a really good question. So just because you set out to pay your mortgage on the 15th of every month doesn't mean you're bound to it for the duration of the term. You can typically call the lender and have them adjust that payment frequency and the date they'll take the payments. And you can also change what account you want to use for that mortgage payment.
That's huge. A huge takeaway there as well is that if you do eventually change this property into a rental property, I highly recommend you change that date of payment to maybe the 10th or the 15th of the month, because as much as a lot of tenants do pay on the 1st of the month, sometimes there's a delay, sometimes there's a banking issue, sometimes there's whatever the issue might be, and giving yourself a buffer before you have to put that cash into the account from pocket is always a huge win as well.
Yeah, some tenants want to pay by check. They're not going to do the Interac e-transfer, and some banks will take 4, 5, 6, 7 business days to clear those funds. So it's important. Like you said, I think the 10th, 15th is a great day for your payment on a rental property.
Amazing. So we covered a lot, and I think it's important to now circle back and see what would you say some of the highlights are. So we covered so much on this, but if I open, I'd say being sure that you understand what the mortgage product that you're taking is and all of the fine print. So whether it's going to be fixed, whether it's going to be variable, what the penalties are going to be like on either of those products. Understanding that there's different options when you're in a different cycle of your buying process, whether that's your first purchase, whether that's a second purchase, an investment purchase, understanding how a HELOC works with all this put together. We just ironed out some of the advantages that we have when using a prepayment and the different options available to you on that front as well, which has been huge. Is there any other last words that you want to leave on our viewers?
I'd say that my favorite thing to discuss with clients, there's 2. It's really the restrictions, right? So the flexibility you can have with a certain product versus a product that might have a more advantageous rate, but much more restrictive. So based on their needs, which makes the most sense for them. And then the second is really, understanding the economic cycle we're in. Where are the trends headed? Where are the rates headed? Is it volatile? Is it stable? Because that'll really help a client decide what product might they be more comfortable with. And not everyone follows economic cycles, right? So it's important to have that discussion, talk about it, just so that they understand where we're at, because a variable, a good decision on a variable rate today might not have been 3, 4, 5 years ago, or whatever it may be. So the situation is also based on the times we're in.
And that's why, honestly, in today's world where everybody is a do-it-yourselfer, where everybody is looking to YouTube like right now for getting advice, we still very much recommend you sit down with somebody to analyze your entire situation, your entire portfolio, your investments, your employment, everything, so that you can really go back and forth and discuss the situation and get the best advice for you. Matthew and myself are more than happy to do this with you. If you have a trusted advisor, by all means, reach out to them, but really don't try to go at this alone. Like I said, everyone wants to do as much as possible alone, but this is not where you want to pretend that you know everything about this and go down that road.
Yeah, we're part of your team in this journey, in this process. And that's why we're here. We're here to be on your team and to give you all the answers you need for all your questions.
Matthew, thank you so much for your time today. I really appreciate it. I know our viewers got a lot of information thrown at them. There is so much great content in here. If you do have any questions, feel free to reach out to Matthew or myself. Our contact information is in the description down below, and I can't wait to catch you on the next video.